Hello traders and welcome to this video analysis looking at the Swiss franc in today's markets. So traders, similar to the Japanese yen, we know the Swiss franc is another safe haven currency that does appreciate in times of market uncertainty because investors see Switzerland as well as Japan as another safe place to put your money in terms of market uncertainty when you have stock markets falling lower or commodity markets falling lower, and that is because of Switzerland's renowned safe financial system. So investors park their money into Swiss government bonds as a safe place to invest, and we know that the Swiss government bonds are sold in the local Swiss currency. So when we have risk off sentiment in stock markets and cash flows into Swiss government bonds as well as Japanese government bonds, this gives both currencies a high demand in the markets. And similar to the Japanese yen, the reason why the Swiss franc is a safe haven currency that only appreciates when other currencies are either getting weaker from interest rate cuts or if there's risk off sentiment in stocks or commodity markets is because of Switzerland's negative interest rate and extremely low inflation. So obviously we understand if you buy the Swiss franc against another currency, the interest rate differential means you lose money overnight, and because inflation's so low, interest rates are not going up anytime soon. So that there gives you a key understanding to why investors, apart from when there's risk of sentiment or other currencies getting weaker, they're not actually buying the Swiss franc because of positive economic data coming out of Switzerland. So like the Japanese yen, dollar's been getting stronger against the Swiss franc. If the Fed doesn't cut interest rates anymore, if risk on sentiment continues in stock markets, we can expect the dollar to continue to edge higher against the Swiss franc, maybe come up to 10100. And that could be a potential trade. I'll put an alarm there. But that's the fundamental driver behind the dollar Swiss franc. Pound Swiss franc, we understand traders, it's all to do with Brexit at the moment. So the election is key, and that's why the pound has consolidated against the Swiss franc. And until there is a clear outcome for who the markets believe is going to win the election in the UK, the pound probably is going to continue to do this because the markets have less of a catalyst to know when to buy the currency. Similar to the euro, we've had similar to euro JPY, the euro has been getting weaker against the Swiss franc since 2018 because of the slow growth in Europe and the slowdown in trade globally hitting the European economy, and the European economy has suffered as a result, and the currency has got lower. This currency pair has gone lower on that fundamental factor due to the euro's performance, not to do with Switzerland's performance. So moving forward, again, the only way the euro can rise against the Swiss franc if you start to have positive data looking like there's been a turnaround in market growth, market sentiment. The ECB maybe moves away from their quantitative easing bond purchasing program, which means that less money is being pumped into Europe, so there's less of a supply of the currency. That means in a supply and demand equation, the currency's value rises, and that's the only situation where we can see the euro rise, or the euro goes lower against the Swiss franc if Europe's economy deteriorates even more. Then, as we've seen from the trend recently, this is what will drive this currency pair lower in the markets. So moving on to the CAD Swiss franc traders. So the Canadian dollar overall since 2019 has been stronger against the Swiss franc, as we would expect. Canada has a much higher interest rate than Switzerland, so overall you make money overnight just by holding the position, even if it doesn't go in your favor. If it just stays still, the difference between Switzerland's negative interest rate and Canada's quite high interest rate, same interest rate level as the United States, means the Canadian dollar is an attractive currency. And we could also expect, should the US-China trade conflict become better, that would boost Canada's economy, and you probably start to see the Canadian dollar strengthen against the Swiss franc. So that's the reason for the Canadian dollar getting stronger against the Swiss franc at the moment. But more sustained moves would really be based on the global outlook becoming even more positive. And then we also have the Aussie dollar against the Swiss franc, the position we're in at the moment, which is in a profit, which is good, and we're going to hold this trade, be patient traders, and just wait for this to continue to move to the upside. But clearly the Australian dollar has been getting stronger, and this is based on the performance of the economy, which could get better if the US and China trade deal does go through, and it's looking more positive, and this is why the currency is now being lifted. And remember, the expectations of interest rate cuts by the Australian Central Bank have been pushed back, so that could support the currency further. So just holding this position open, traders, and just being patient. New Zealand dollar hasn't been able to move as high as the Australian dollar, and that's because interest rate cuts are still being expected by the markets, and until that situation is removed, the New Zealand dollar is very unlikely to strengthen against the Swiss franc. So traders, that's my analysis on the Swiss franc. Thank you for watching.